Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
October is considered a power month for seasonal strategies. And did you know? SBUX has closed positively in every single Q4 of the last 15 years. Success rate, 100%. And BlackRock? An asset manager that is also a tech platform. Welcome back to Learn for Finance, October Part 1.
Absolutely, Lisa. And before we dive into the figures today, I want to share something important that comes directly from our community and perfectly describes our approach. One of our loyal viewers wrote to us, and I quote, "Thank you, Axel. This is a great enhancement. Because now, through your qualitative analysis, I even get suggestions for stocks that I hadn't even considered. Great symbiosis. I am happy to accept longer video durations for this. In the long run, it even saves me time." And that is exactly the core of our further development. We were thrilled with this feedback because it shows that you recognize the strategic added value. It's no longer just about finding a purely quantitative trade. We want to know, is there also a quality company behind the seasonal pattern that might even be worth holding long term? This deep dive is the bridge to our individual stock analysis.
An intelligent symbiosis that brings you maximum benefit. And because October provides so many signals, we are splitting the analysis into several parts. Today, as an introduction, as mentioned, SBUX and BlackRock. Let's start with SBUX, the world's leading provider of premium coffee. With over 38,000 stores in more than 80 countries, the company combines brand strength with a global store network and increasing digitalization, from mobile orders to loyalty programs.
We expect a revenue of over $38 billion for 2024. The gross margin is around 27%, and the EBIT margin is approximately 14%. Particularly impressive is the return on invested capital at about 25%. Additionally, there is a dividend yield of approximately 2.5% and active share buybacks. The balance sheet is moderately leveraged but well covered by strong cash flows.
The competitive advantage, the moat, is multi-layered. First, the brand itself, which stands for consistent quality. Second, digital customer engagement. Alone in the USA, there are 33 million active rewards members offering significant data advantages and upselling potential. And third, global scaling through standardized processes that enable an efficient rollout of new stores worldwide.
The opportunities are clear. Expansion into China, even if it falters in the short term, remains a huge market. Digitalization drives efficiency, and product innovations such as cold beverages, which already account for over 70% of sales in the USA, or new energy drinks offer further potential. However, the risks are also real. Dependence on consumer mood, cost inflation for wages and raw coffee, as well as competition in core markets. The key factors are the stable fundamental data, the consumption dynamics, especially in China, innovations such as AI-supported supply management, and global partnerships. On the risk side, volatile raw material prices and potential labor conflicts, and this solid foundation meets a perfect seasonal pattern. The window spans from buying on October 3rd to selling on December 7th. The average return over the past 15 years, 10.87%. The median was 10%. The hit rate, 100%, 15 out of 15 years were positive. And this with extremely low volatility of 7.7% and a maximum drawdown of 0.
A statistical dream. But does SBUX also pass our qualitative flop filter? Here is the complete unabridged score rating.
Let's start with the fundamental data. Here, we award 5 out of 6 points. The business model is proven globally and extremely scalable. The ROIC is strong at over 20%, and the cash flow is stable. Slight deductions are due to the short-term margin weakness in China and the pressure from input costs. There are also 5 out of 6 points for the competitive advantage, moat. The combination of brand, app, and community creates strong customer loyalty. However, it is not a technological monopoly, and there is locally limited competition. In our qualitative scorecard, we achieve 8 out of 10 points. Full marks, 2 out of 2, are awarded for scalability, pricing power, and return on capital. Deductions, each 1 out of 2, are given for management quality due to the recent change and for cyclical resilience because of dependence on consumer sentiment. We award 4 out of 6 points for the valuation. The price is slightly below the historical valuation level, and our DCF analysis shows an upside potential of 10-15%. This is attractive for long-term investors, but not a massive undervaluation. And the shareholder focus is very solid with 5 out of 6 points. There is a reliable dividend history with annual increases, active buyback programs, and well-covered moderate debt.
This totals 27 out of 34 points. A clear result. StarBucks is not just a seasonal trade, but a genuine quality company with a digital moat and consistent return to shareholders. A clear candidate for October. Let's move on to BlackRock, the world's largest asset manager. With assets under management of around $10 trillion, the company is a giant in asset management. But BlackRock is more. With Aladdin, a market-leading risk and portfolio management software, the company also acts as a central tech provider for the global financial system.
The financial figures are excellent. Revenue is approximately $17.5 billion. The net margin is extremely strong at over 30%. The same applies to the EBIT margin of over 38%. The return on equity, ROE, stands at a solid 15%. Additionally, there is a dividend yield of 2.8% and a history of targeted counter-cyclical share buybacks. The balance sheet is robust, with high liquidity and low debt.
The competitive advantage, the moat, is extremely broad. Firstly, the economies of scale. With 10 trillion AUM, BlackRock can profitably offer products like iShares ETFs at extremely low fees. Secondly, technological leadership through Aladdin. The platform is used worldwide by pension funds, banks, and insurers. This creates recurring SaaS revenues and a strong lock-in effect.
The opportunities lie in the demographic tailwind from global retirement provision, expansion into emerging markets, and the increased monetization of Aladdin. The risks are clearly the dependence on market cycles and stock market development, the increasing political and ESG criticism, as well as competition from low-cost providers like Vanguard or Fidelity. In summary, the key factors are the enormous economies of scale, the high margin strength, Aladdin's technological lead, and the stable capital return to shareholders. The valuation is currently fair, with a slight discount to the historical average, which supports a DCF potential of 10 to 12%. Seasonally, the strong window runs from buy on October 3rd to sell on December 27th. The average return over the past 20 years was 16.1%, with a median of even 17%. The hit rate is a strong 90%. The volatility is very low at 7.8%, resulting in an excellent Sharpe ratio of 2.06.
A strong seasonal window paired with an excellent business model. But how does this translate into the qualitative point rating?
Let's start with the fundamental data. Here, we award the full 6 out of 6 points. Very high margins, with a net margin of over 30%, a strong and stable cash flow, and a robust balance sheet profile form an excellent foundation. There are also 6 out of 6 points for the competitive advantage, moat. The size advantages are hardly reproducible. Aladdin provides a technological lock-in, and the global trust advantage among institutional investors forms a combined moat of scaling, trust, and technology. In our qualitative scorecard, we achieve 9 out of 10 points. Full score, 2 out of 2 for scalability, capital return, management quality, and cyclical robustness. The only deduction, 1 out of 2, occurs in pricing power due to the general fee compression in asset management. In the valuation, we assign 4 out of 6 points. The PE ratio is slightly below the historical 5-year average of over 20, at approximately 18. Our DCF analysis indicates a moderate upside of 10 to 12%. This signals a moderate undervaluation with high stability. There are again the full 6 out of 6 points for shareholder focus. The dividend history is exemplary with reliable increases. Buybacks are strategically used during weakness phases, and the capital structure is extremely solid. This is capital discipline at the highest level.
This results in an impressive total of 31 out of 34 points, an excellent score that confirms BlackRock as a stable quality asset with platform characteristics, a top address in the financial sector for October.
Let's summarize. SBUX scores with incredible brand strength, a digital moat, and a perfect 100% hit rate. BlackRock is a financial fortress with a tech platform character and an almost perfect qualitative score.
In direct ranking, BlackRock is clearly ahead with 31 points. But as you can see, both are absolute quality companies where the strong seasonal pattern meets a solid foundation. And that is exactly the added value of our new approach. In Part 2, new exciting candidates are waiting. Leave a subscription and write to us. Which of these 2 stocks would you like a complete individual stock analysis of? Your feedback guides our content.
Thank you very much for your interest. Learn smart, invest smarter.
Disclaimer: the content on the YouTube channel, Learn for Finance, is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations or forecasts are no guarantee of future results. Important note: investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.